Hi, this is Brett Hickey, founder and CEO of Star Mountain Capital. I'm delighted to be joined by my partner, Dr. Lev Borodovsky, our Chief Risk Officer, to give you a little bit of update on the economy, including around the virus, that we hope you will find helpful for your business and personal matters. Star Mountain, as a reminder to many, is a specialized asset manager. We are focused exclusively on investing in the U.S. lower middle market, which in plain English is businesses that are established and generally have over $3 million of annual EBITDA, or you can think of that as pre-tax earnings, and typically don't have more than $20 million of EBITDA. We also have a secondary business where we provide early liquidity to investors that would like to sell their limited partnership interests in other lower middle market funds. So we are both a lender, a private equity investor, and a secondary fund purchaser in the U.S. lower middle market, which provides us with a lot of data and insights that we believe are helpful in investing and we hope will be of interest to you all as well. I've been investing in this market now for approximately 20 years, following being an investment banker at Citigroup Solomon Barney in New York. And my partner, Dr. Lev Borodovsky, has been a risk officer in the investment space for about 25 years, where he also used to work for our chairman, Brian Finn, that was the head of Credit Suisse Alternatives, before spinning out of Credit Suisse with the GSO team as the founding chief risk officer of GSO Blackstone, one of the preeminent credit shops built in the U.S. Lev also writes a piece for the Wall Street Journal called The Daily Shot, which is very informative, great graphical driven data that I highly encourage you to look into if you're not already following. Let's talk about market valuations a little bit. Many talk about a world right now of two stories. One story is the economy. As we know, the economy is very challenged, and while we are starting to see recovery, it's from a very low point. And the second quarter of this year is going to be a very difficult year for many companies from a both revenue and cash flow perspective. If you just follow the public markets, you see a different story. Right now, the public markets are back again at near multi-decade type of highs on a forward price to earnings ratio, which is really a reflection of a couple things. One, there is sentiment by many that businesses will recover and then continue growing very strong. They understand that there is some shorter term challenges, but when they look out long term, they believe that will all pass and continue to be strong again, similar to the past decade that we just finished growing through. There is a second dynamic that's overlaid, which is the amount of capital that's sitting around and a lot of people having a fear of missing out that may be greater than the fear of loss. Our house view at Star Mountain Capital is that there are more challenges in the economy generally than what the public markets would be telling you and looking at. As a cautionary note, and we are certainly not here to time the markets for anybody, we focus on private market investing only, but when we look at the fundamental economic data of the U.S. and global economies, we think that the current stock market valuations are puzzling a little bit to many of us. Let's talk about the virus a little bit. Virus and the economy are obviously highly correlated and intertwined. Thankfully, the whole world is really pushing hard and trying to find vaccines at different types of ways of recovering, treatments, cures, and so forth. As you can see here, there are over 60 leading parties around the world that are focused aggressively on research and developing vaccines, which we think is very encouraging for the long term, but we would note that vaccines do take time. They need to be tested. They may need to ensure that the side effects can be managed and mitigated. So there are a lot of considerations to take into account thinking on a more short-term basis. Maybe think of short-term as the next 12 months, but certainly beyond that, there seems to be a tremendous amount of hope, which is encouraging for society. From an infection and fatality rate, as you can see here, the U.S. confirmed cases has continued to drop, as has U.S. fatalities, which is very encouraging for society. And we hope will continue to move forward, although there's certainly some questions around pace of reopening and should that cause for a bit of a W shape with a slight extra resurgence. Let's talk about a little real working from home. Pardon me, my son just came into my room as he gets ready for bath time. I'm sure we're all working through that, so apologies for the quick delay there. Let's talk about New York State and how New York State is fighting the pandemic as well. You can see that the death rate has dropped dramatically, and that's certainly very encouraging signs for all of us. And the state has stated to be going through a larger reopening shortly here on June 8th. Looking at the entire United States, as many people know, the country is really reopening at different degrees. It's going to be, of course, very important how policymakers choose to reopen to try to avoid a second hit of COVID. There have been some indications of that in certain states that can happen, but the states need to reopen. They are reopening, and that's really good to see, and we hope it'll be done in a prudent, measured manner, which really all of us contributing to how that's done, I think, is critical. We can see here that different types of industries are reopening. You can see here where they're reopening on a state basis. There are certainly other business lines such as fitness and gyms that are not yet reopened for the most part, and a lot of questions as to when they will be reopening, but there is a lot of reopening that is occurring, which is, of course, encouraging. Let's look now at some of the mobility as some additional data on what's going on with the economy. Here you can see driving, mass transit, and walking. Driving and walking has continued to be accelerating while folks remain fearful of mass transit in general. I know in New York, Metro North has mandated masks for being on trains. I think that's a good thing, and I presume society here in the U.S. and presumably other regions may follow other countries like South Korea and how they've operated, and that become a little bit more of a normal way of life, at least in the certainly short and medium term. Another data point that Lev and I were talking about earlier is within driving, to note that the consumption of gasoline has really not picked up from an energy consumption basis to before, which would lead people to think that a lot of the driving that's happening is much shorter distance driving. Now let's switch over and let's talk a little bit about the economy here, and then we'll get into a few other kind of data points. So I'll pass over to Lev to talk about. We talked a little bit about our view here as Star Mountain versus the public market, and you can see it here as well. The consumer confidence sentiment, which is the index of consumer sentiment, the ICS, compared to the S&P. You can see here that the S&P continues to really grow and has rebounded in a way that is extremely different from sentiment and how people really feel from a confidence perspective. And Lev, what else do you think about that? Any other insights? That's a big divergence.
Yeah, and some of this has to do with the different views from institutions versus individuals. So you have fund managers who are sitting on a lot of cash, and they're not as concerned about consumer confidence. They just want to make sure that they don't get left behind as the market recovers. And so they don't want to underperform, and so they're jumping in. At the same time, the consumers remain pretty nervous. In fact, this consumer sentiment from the University of Michigan actually dipped in the second half of May, which so it's not, it's the recovery in sentiment is going to be much slower than what's happening in the stock market.
That's helpful. Thanks, Lev. What do you think here is we see, Lev, that the credit card spending is starting to pick up, as are U.S. mortgage applications. Any other insights do you think would be helpful other than seeing the trend lines continue to move back up in a positive direction?
Sure. So the one nice thing on the credit card side, that the one nice trend is that you're starting to see credit card spending in brick and mortar establishments. So people are getting out and they're shopping, and it's going to help sustain some of these businesses that have been through some very challenging times, versus just online, which is what we saw during the lockdown. On the mortgage applications, it's a really interesting and a very positive story. The housing market has been exceptionally resilient. It's just been absolutely remarkable. Mortgage applications are now completely rebounded to pre-crisis levels. And there are a couple of trends there. One is people have been saving money, and now mortgage rates are at record lows or near record lows, and people want to take advantage of it. This is their time to do it. There's another trend that is a little different, and that is people living in apartments in sort of more crowded cities and downtowns want to get out. They're nervous about the epidemic and being a part of big crowds, and so they're buying homes in the suburbs, and that's part of the trend here.
That's great. Yeah, we certainly see that up here in Westchester and Connecticut. From a recovery expectation, we thought this polling from the Wall Street Journal was interesting to see when people think the stock market will fully recover. You can see here that about 65% of responders expect that the stock market will recover within the next 2 to 12 months. So I think this is a good way to kind of think about sentiment, generally speaking. As Lev mentioned, the 10-year Treasury is at extreme low levels. It reached 70 basis points. And Lev, today I think you mentioned the 5-year reached an all-time low. Is that right?
Yeah, so this morning we dipped below 0.3% on the 5-year, which is a record low.
That's fantastic. So I guess good for those locking in low rates to do things with. As we look at some economic data that's important, there have been the weakest ratings across the middle and large market leveraged loans is generally what this index represents here from Standard & Poor's. But you can see that in red, the CCC and lower rated fixed income securities are back up to all-time highs compared to the last recession, and the single B minus or lower have actually now surpassed the highs from the last recession. So certainly from our view, there's going to be a lot of people that will be forced sellers of assets and looking to sell assets come the second quarter of this year, and that's certainly something with our secondary business, some of our other strategies that we're carefully looking at from an opportunistic perspective, and a lot of people should probably be paying attention, thinking about what kind of things might be in their portfolio that have exposure to what could be a pretty challenging second quarter of this year. Credit rating deteriorations have, of course, spiked. Related to the last, and this is, I think, just helpful to see the magnitude of that spike. From a pension fund perspective, is one way of looking at a pretty broad return exposure. The quarterly returns in Q1 were worse than the losses from the last recession from Q4 of 2008, making it the worst quarter that the U.S. public pension plans have faced in the last 40 years. As we look into what's happened since the second quarter of last year, this is an interesting chart here that breaks out showing different periods of time. Probably most relevant is the green color, which goes from the end of March until the end of May. So you can really see how sectors within the S&P have performed, and you can see that the sectors have largely, bounced back quite aggressively, as has the S&P and many other indices. And one of the big reasons behind that is the Fed's stimulus. We've talked about this before, but there's really been an unprecedented level of government stimulus. And you can see here across the different verticals of commercial paper funding, money market, Main Street, the PPP program, Payment Protection Plan that stands for, and others. Lev, any insights that you find interesting as maybe looking at this slide and then also overlaying this with just the speed and amount that the U.S. has stepped in to help boost the economy? Any takeaways you think would be helpful for folks?
Yeah, just as a general note, the lessons of 2008 are pretty fresh in a lot of policymakers' minds, and they didn't want to be caught in the same situation as they were in 2008, where the recovery was really slow. They wanted to be aggressive, and both the Fed and Congress acted rapidly, and with the $3 trillion stimulus package. What's interesting about this, and one of the reasons the stock market continues to rally, is that there's apparently more on the way. And the public expects more, and Congress expects more. There's more additional support for small businesses, and potentially additional extension of, bigger unemployment benefits and other types of stimulus packages that are yet to come.
That's helpful. Yeah, and I think on behalf of certainly U.S. small businesses, where we focus in established, not startup type of companies, but private businesses, I think that the U.S. is going to benefit from the pace of which the government has provided stimulus that allows for U.S. companies to have more liquidity, be able to retain jobs better, rehire people better, and I presume that will provide the U.S. with additional competitive advantages relative to other countries, and then as well the U.S. of course having a lot less dependency on international trade should be a further benefit on a relative recovery basis for the U.S. And here you can see a little bit of where this capital has come from, and just see the magnitude of how important this capital from the government has really been. The Paycheck Protection Program, or the PPP program as referred to, has dramatically outpaced the money to small businesses relative to banks as a good comparative point by around 7 times. As we look here at some of the banks, a lot of this relates to real estate, but there are definitely challenges within commercial real estate, and you can see here how many banks have had to, and this is just a subset of banks for sake of clarity, not all, from a Jenny Montgomery Scott research report from a couple weeks ago, but it's showing how many of the bank's loan portfolios are in deferral, meaning that their underlying borrowers are not paying them on a current basis. Those are some pretty high numbers when you start to get into 15 to 22%. Lev, how do you think about the economy as we head into Q2? We know Q2 is going to be a much harder number than Q1 was, but the economy is starting to recover, so that'll hopefully be trending well, or much better at least for Q3. How do you think about the banks, the default rates in general, and whether we expect this to get worse before it gets better still?
Yeah. So the mortgage situation is such that you have an increasing number of people deferring mortgages, and some of this reflects deferred mortgages. And that's been obviously helpful for the public. The question is when is these mortgages going to start getting start paying again, and that remains to be seen. I mean, people will try to push it pretty far. So in Q3, we might start seeing some of these banks saying, "Look, it's time you start paying the mortgage." On the commercial real estate side, there may be situations when there's just no recovery, and I think the commercial real estate will face some significant challenges in the months to come. The cash flows have stopped, and in a lot of cases, and a good portion of those are not coming back.
Yeah, we talked to one of our family office investors that is a large real estate owner that has both residential and commercial, and interesting enough, he said he's been able to do a really good job keeping their residential clients paying at a pretty high rate in the mid-90s, but that the commercial borrowers, that something like 85% of them just stopped paying. And what are you supposed to do? How do you take them to courts? How do you extract money? Who else are you going to replace that tenant with? Not an easy dynamic for commercial landlords, certainly. A little more information on a relative basis globally. Here, this looks at different central banks' responses as far as capital injections, and it's always, we think, helpful to see things on a relative basis. So here we're comparing it on the left. You can see central banks' holdings of government bonds as a percentage of their total issuance. And I think when I look at this, I see countries like Japan, the UK, the Eurozone, where the central bank is holding a much bigger percentage of it versus other type of holders, on a private sector basis. And on the right, where we see the central bank's balance sheets looking at it another way is as a percentage of the GDP. I think it bodes well on a relative basis that the U.S.'s central bank balance sheet is much lower as a percentage of GDP to certain other countries, particularly Japan, of course, and the Eurozone. Lev, how do you think this matters? Is this something that people need to care about over the next year or two, or is this more of when you're thinking kind of 5-10 years out?
There's a little bit of a concern that in the longer run, you're going to start seeing some inflationary pressures. That's simply because when you flood the economy with liquidity that it can't really use, productively, at some point you're going to start seeing higher prices. And for now, we're in a deflationary or disinflationary environment. And so there's really, in the intermediate term, all this is going to do is keep rates very low as central banks, buy government securities and other types of securities, whether it's the ECB or the Fed or the Bank of England. And some central banks will continue to extend those programs. The Bank of England, for example, is expected to extend its securities buying program and maybe take rates down below zero. So central banks will just keep rates extremely low. Like you said, Brett, longer term, I think it's a potential risk for in terms of spiking inflation, at least to some extent.
And what are on that note of inflation? People ebb and flow around that. I know that we do our loans with floating rates and so forth in case inflation comes in. How do you, what do most economists right now forecast from an inflation perspective? Do they assume that we're not going to see inflation for at least the next year or two? What's kind of common consensus?
Yeah, so in the next couple of years, inflation expectations, say market-based inflation expectations, are sitting below 1% or close to it. So very low, disinflation, what I'd call disinflationary environment. Economists also say, look, rents are going to go down because the demand is slower. You're going to have, energy prices are still very low. And so inflation will be under control. Once you take it out to 5 years, things could change. And there's some concerns that there's just so much liquidity in the market, in the economy, that it will start becoming inflationary.
That's helpful. So most people then, or most economists right now, are viewing that there's likely not too much inflationary risk over the next 1 to 5 years, but after that there's certainly a lot of factors that could lead to inflationary pressures. Here we see the rise of mortgage servicing portfolio, or the percentage really of portfolios that are in forbearance, and as you can see, there's been a large uptick in that, so nothing surprising, just a little more data with respect to real estate. This next slide shows us different global sector output and forecasts. So the first quadrant here you can see is for the first half of 2020, second half of 2020, and then the first and second halves of 21. And this here breaks down by your motor vehicles, textiles, electronics, headline manufacturing, aerospace, and other, where you can see some sectors are forecast to have continued challenges even a year or so out from now, whereas a lot of sectors are expected to start to come back more, just as far as people think about their portfolios, sectors they're investing in, and so forth, is hopefully helpful. Here you can see U.S. vehicle production really starting to rebound, which I know is helpful for a lot of folks in the automotive sector. Lev, anything you think is particularly important from a U.S. vehicle production standpoint?
It's people are shopping for cars. It's one of these things that Americans want their cars, and probably more so now because there is people are afraid of public transportation. They want to be in a private vehicle, and so you're going to see not just trucks but also cars starting to rebound as far as demand. And with interest rates being as low as they are, a lot of dealers are offering no interest packages. People are coming back to the dealerships.
Yep, good time to be getting a car if you're looking for one. Here you can see where inflows have been. This is a complex chart, but at the end of the day, the outcomes from it really show how much capital inflows have gone into healthcare and technology. Those are key sectors where you can see that people have really focused on investing capital, whereas there are other sectors, probably not surprisingly, such as consumer discretionary, financials, and industrials that have really lagged from a capital inflow perspective. And as you forecast right to the most recent data towards the end of May, you can see that most of the sectors do in fact have positive inflows into them, but the brown and the blue, you can see, have really consistently maintained strong growth. Here you can see some other data points around home builder surveys and airlines as far as confidence is concerned, and you can see that confidence really is rebounding, and I think that's good to see in the airlines given how challenged they've been hit, that people are starting slowly and in highly socially distanced and governed manners, but starting to get back into air travel as well. Here we look at some global manufacturing rebound and outlook, and one of the things we thought was interesting about this is to look at this. Of course shows you a bit of a V shape, but I would call out that you look at when things are looking to kind of get back into V levels this way, because the view of this is probably a wider V versus a tighter V from an economic expansion perspective, and the U.S. is projected to not only recover faster but also have some positive benefits benefiting from the federal government's faster response to stimulus and other things that should help the U.S. economy on a relative basis to other economies. This page shows that the U.S. GDP was less impacted in Q1 than UK and Eurozone. Just as you look at a few market comparisons, a lot of people ask us about that, and we thought some of this information, would be helpful. Let's talk about where we view the economy heading now. This is Goldman Sachs's Global Investment Research forecasts, where they're looking for positive real GDP growth as early as the third quarter of this year, which is certainly provides some optimism for people. The U.S. savings rate has spiked a lot, which is positive, certainly, although could be a bit misleading given the stimulus dollars that have been provided to a lot of Americans that have in many cases just not yet been spent. So this is less of a systematic shift of everybody saving more and more so a government stimulus spike, which should be good as far as when people look to spend that money. Hopefully that will help the economy with recovery when that money gets spending again. Another positive trend that we're seeing is the unemployment filings in the U.S. continuing to drop, and ultimately that's where things trend. So from our vantage point, things are looking cautiously optimistic, are recovering, but we do believe there are real risks of another ramp up in COVID. We think that the medium-term trends of vaccines and treatments for COVID-19 and other viruses, frankly, are looking very positive, but it's unclear as to how strong they will be for this cold and flu season coming up this winter. And so we would certainly encourage people to be mindful and thinking of that for your own health and wellness. And while I know everybody wants to get out and get engaging with their relationships and friends and family, I think it is a good suggestion for all of us to make sure we maintain prudent measures for how we're doing that to avoid outbreaks that could happen for our families, our loved ones, and from a business perspective, we know people need to get back to work. We're certainly very supportive of that, but we do think that it should be done in a cautious and controlled manner, recognizing that that's not as fun for people to do. It creates challenges in operating, but we do think it's beneficial. And with that, Lev, any other final kind of words that you think would be helpful for people as we forecast the next few weeks here for folks?
I think as the economy reopens, we're going to see a rebound, but it's going to be slow going, and the jobs will come back. But again, it's not like a switch that gets turned back on and we return back to normal. It's going to be a slow, difficult, challenging period ahead. But I think the worst is over.
That's great. Well, Lev, thank you very much. Thank you for all of our listeners. We certainly appreciate all the questions and comments from other folks and from investors of ours that have asked different things. We hope you all have found this to be good information. And if there are other suggestions or questions you have, please don't hesitate to reach out to us. We wish you all health, safety, and happiness.